Now the question goes as, a company PQR Limited purchased a machinery for rupees 10 lakh on 1st January 2004. It is to be depreciated at 10% on reducing balance method. Now students, reducing balance method implies written down value method. On 1st July 2005, that is next year, this machine was damaged and was sold for rupees 6,50,000. You are required to give journal entries and machinery account both, assuming that the accounts are closed on 31st December each year. So now starting with it, on 1st January 2004, we have purchased a machinery, so entry would be machinery account debited to bank. Machinery account debited to bank. Machinery is a real account, so debit what comes in. Bank is a personal account, so credit the giver. Narration would be being machinery purchased, and the amount would be rupees 10 lakh. This entry signifies that a machine has been purchased during the year. There is no purchase or sale, so at the end of the year, that is on 31st December 2004, depreciation would be charged, that is depreciation account debited to machinery account. Now again the rules are same, depreciation is a nominal account, so debit all expenses. The narration in this case would be being depreciation charged, and it would be 10% of rupees 10 lakh, that is rupees 1 lakh. So now we have purchased a machine, and at the end of this year we have charged depreciation on this machine. We know that depreciation is an expense, so at the end of the year, that is on 31st December 2004, this depreciation should be transferred to profit and loss account. So entry would be profit and loss account debited to depreciation account. The narration would be being depreciation charged to profit and loss account, and the amount would be rupees 1 lakh. Now this completes the entries for year 2004, that is we have purchased a machine. At the end of this year we charged depreciation on that machine, and on the very same date, that is the last date of the year, this depreciation was transferred to or charged to profit and loss account. So for year 2005, this machine was used for 6 months, that is from January till June. So depreciation would be charged for 6 months. Entry would be depreciation account debited to machinery account. Again narration would be being depreciation charged. Now students, it is a case of reducing balance method, that is written down value method. So 10% would be charged on 10 lakh, that was the original cost, minus 1 lakh depreciation for the previous year. That is, it would be charged on 10 lakh minus 1 lakh. So the amount comes to, or the book value comes to rupees 9 lakh. So in this case, depreciation would be charged for 10% for 6 months on rupees 9 lakh, and it comes to rupees 45,000. Now on the same date, it is given that this machine was sold. So on the same date machine was sold, we will be receiving the money, that is bank account debited to machinery account, and it was sold for 6,50,000. Narration would be being machinery sold. Now students, we will have to calculate profit and loss. So let us make a small working note to calculate profit and loss here. Let us calculate the book value of machine on the date of sale. Book value on date of sale. This machine was purchased for rupees 10 lakh. Depreciation for first year was 41 lakh and for second year it was 45,000. So the book value is rupees 8 lakh 55,000. A machine worth rupees 8 lakh 55,000 has been sold for rupees 6 lakh 50,000. So the loss for this year would be, or in this case would be, rupees 2 lakh 5,000, which would be recorded as profit and loss account debited to machinery account. And the narration would be being loss transferred to profit and loss account. So now students, again just to repeat the calculation, this machine was purchased for rupees 10 lakh. In the first year we can see that depreciation of rupees 1 lakh was charged, and in second year this amount of 45,000 was charged as depreciation. So the book value on the date of sale is 8 lakh 55,000, and as an asset worth rupees 8 lakh 55,000 was sold for 6 lakh 50,000. Hence we can clearly say that there is a loss of 2 lakh 5,000 which should be transferred to profit and loss account. Now continuing with the same question, here we are preparing machinery account. So just to recall, on 1st January 2004 a machine for rupees 10 lakh was purchased. It is to be depreciated at 10% on reducing balance method, and on 1st July 2005, that is next year, this machine was sold for rupees 6 lakh 50,000. So starting with machinery account, on 1st January 2004 to bank, since it is purchased to bank account, amount would be rupees 10 lakh. Now accounts are closed on 31st December each year. So at the end of this year, that is on 31/12/2004, depreciation would be charged. It would be recorded as by depreciation account, that is 10% of this 10 lakh. So depreciation is rupees 1 lakh. Now at the end of this year, we'll calculate the balance. 10 lakh minus 1 lakh, it would be by balance carried down rupees 9 lakh, and the total is rupees 10 lakh on both the sides. This closing balance for year 2004 would be brought down as opening balance in year 2005 and would be recorded as or posted as to balance brought down 9 lakh. In this year, on 1st July 2005, this machine has been sold. That means from 1st January onwards, it has been used for 6 months. So on 1/7/2005, by depreciation, that is 10% of 9 lakh for 6 months. Since it is reducing balance method, the depreciation would be charged on book value, which in this case is 9 lakh. So 10% of 9 lakh for 6 months comes to rupees 45,000. On the same date, this machine was sold. So the posting would be bank account, that is sale, for rupees 6 lakh 50,000. Now students, this machine had a book value of 9 lakh. 45,000 rupees was charged as depreciation during this year. That means book value in the beginning of the year, on the date of the sale is 8 lakh 55,000 and was sold for 6 lakh 50,000. So by P&L account, loss comes to rupees 2 lakh 5,000. Totaling the balances, or totaling the both the debit and the credit side, it is 9 lakh on both the sides, and since there was only one machine which has now been sold, there is no balance to be carried down to next year.